So I found a few key things to be quite impressive. The first thing that struck me was the seniority of the government representatives in the room, even before the president joined us. So you had the Secretary of Commerce, then you had the Secretary of the Treasury, you had David Sachs, you had the Congressional Whip Tom Emmer, you had Brian Stile, the chair of the Subcommittee on Digital Assets, you had a number of other key government representatives, key people from the regulatory side at the SEC and the CFTC. So very, very senior people. These were not just their representatives. Their representatives and the people below them were also there, but the very, very key senior people were there themselves. So some of the common themes at the Crypto Summit were around Bitcoin and the Bitcoin reserve, since that recently happened. How should that evolve? Other common themes were the process of proper regulation and making sure that there are actually clear regulations that allow fintechs and financial institutions and DeFi protocols to all participate in the US financial system with legal clarity. There were some views about how the US has to be the place that originates the asset, that is the place that creates the asset that then flows into the global financial system from the US market. That was basically my view and a few other folks. And then there were one or two good views on infrastructure and how to get infrastructure adopted by the US. My position on the key topics of how the US financial system should evolve from this point is that, firstly, it should generate the base original asset that everyone else packages and repackages, whether that's a DeFi protocol, a neobank, or a large financial institution. The original asset has to originate in the US. And then the repackaging can be done, but all these different groups, some of them based in the US, some of them based outside the US. To make the best asset in the US financial system, my view is that you need to build the most reliable asset. And the thing that blockchains do, in addition to transferring ownership, is they are very good data transfer mechanisms, namely things like proof of reserve, proof of liabilities, proof of composition, and by extension, things like proof of solvency. So various proof ofs, which in my view will play a similar role to the role that risk agencies played in the early stages of the Web 1, Web 2 financial system, where risk agencies were legislated into existence, and then they upheld certain reliability guarantees about US financial products that were quite valuable in the beginning stages of the Web 1, Web 2 version of the financial system. And so similarly, I think we should get to a place where things about assets are very reliably proven on a near real-time basis, so that you don't need annual audits, you don't need monthly audits, you don't need weekly audits, you get second-by-second audits. And that creates a more reliable base asset. Once you've created that more reliable base asset, then you're able to sell it to a larger and larger market, as long as two things are true. One thing that needs to be true is that that base asset needs to be connected to all the chains where the purchasing power is. And that's where you need a highly reliable and compliant cross-chain system, like CCIP, that can allow all of that capital to flow and buy that asset. The second key component is automating compliance. Automating compliance is something I'm working myself very deeply on now as I meet with various central banks, regulators, and financial institutions. Compliance is really where the cost of a transaction comes from in the traditional financial industry. And if you are able to take that cost down, then you make the asset and the transaction more attractive, right? So if the US is able to generate the most reliable, highest quality asset of its type in the global financial system, if that asset is connected to all the different chains and environments that can purchase it, and if that asset can be acquired and managed and held at a low cost, because the cost of compliance has been automated away through Oracle networks and identity oracles and smart contracts all working together to automate compliance, then you have the next generation of the US financial system, what we call the US financial system 3.0, where the assets are all rapidly being generated in the US. The assets are then connected globally in a way that allows various chains and various private keys on those chains to buy that asset. And then they can buy that asset with large amounts of capital that can comply, but they comply in an automated, low-cost way. These are the three key properties that really any financial system needs to meet in order to really grow and succeed in our industry and in this new version of the global financial system. And so it is the same properties that the US financial system needs to meet. That was kind of my position on things at the Crypto Summit. And I think it was well received by both the government folks and the industry folks, which is very important because we're going to have both of those groups want to participate in that vision of the United States financial system 3.0. I think at the roundtable, everyone had a pretty brief time to direct any questions or comments towards the president or the government representatives. So I think at this early stage, it's useful for them to know that our industry is very open to collaborating with them, and that the industry really hasn't reached its full potential, and that we're genuinely grateful to the president's administration, his executive orders, all of his secretaries, David Sachs, Bo Hines, these people, for kind of unwinding that suppression of our industry. So I think right now, where everyone agrees is that our industry in the US has not reached its full potential, and that it's very good that it's now starting to be kind of unlocked to reach its full potential in the US financial system. That is something that I think we should be grateful for. That's a good way to bring in our relationship with the US government, various regulators, kind of encouraging them to continue to go down this path of unlocking the full capabilities and full potential of our industry. Once those capabilities and potential is more unlocked through stablecoin legislation, through proof of reserves and proof of general legislation, through market structure legislation, through various forms of new, more permissive regulation that makes it clear how to do a reliable, compliant on-chain transaction, then I think the conversations will start to become more detailed. But I think we're at a very exciting, very productive early stage where a lot is getting done, thanks to the people at the most senior level taking the growth of our industry very seriously. And I think fundamentally they should know that we really appreciate that, and that our industry is going to work really hard to take full advantage of that and reach its full potential. I think the current administration and the climate in DC has three primary focus areas, because those focus areas have sufficient economic force behind them. That's the main reason. The first area is cryptocurrencies, things like Bitcoin, the Bitcoin reserve, a digital assets reserve, because the cryptocurrency market has reached a sufficient size that the folks in Washington care about it, because it's sizable enough to affect the US economy and US interests generally. The second category is market structure. So that is the definition of what is a security, what is a commodity, how do certain exchange-related things operate, if it's a security or a commodity. That kind of forms the foundation for the next version of the US financial system being on a blockchain. Because once you create that regulatory clarity, banks, various large institutions, fintechs, even DeFi teams can know that if they issue a token in the US financial system, it's a security or it's a commodity, and what they need to comply with in order for that to be done legally, and therefore what the capital that wants to buy that asset needs to do in order to buy it. So it's going to open up, in my opinion, a big market once you have clarity on what's a security, what's a commodity, how do exchanges work, how do these things operate. The third category is stablecoins. Stablecoins is once again because a significant percentage, single-digit percentage points, anywhere from 2 to 5% of U.S. Treasuries are now in stablecoins, right? And so because they're in stablecoins, that has reached a significant enough size that the U.S. has to pay attention to that container and that format for U.S. Treasuries, where basically the U.S. Treasuries are being repackaged, rewrapped into an on-chain form that's then used for various transactions. Now, stablecoins have massively benefited the U.S. dollar, in my opinion, and I think they're starting to realize that the stablecoin market and the stablecoin technology and the stablecoin use cases are basically U.S. dollar distribution mechanisms. So they're seeing two very important economic forces that they care about a lot here in D.C., which is what percentage of the economy is this thing? Does it matter? Okay, 2%, 3%, 4% is enough that I do care about this. That's a significant large percentage of the U.S. Treasuries market. That puts you in the top 20, 30 total holders of Treasuries, right? That's important. The U.S. government has to manage that, understand that, regulate that, control that, and manage the risk on that. Things like proof of reserves already exist in some of these stablecoin bills, but I think one of the first places where various forms of proof of composition, proof of solvency, proof of liabilities, proof of reserves, all these things can take greater and greater shape is in the stablecoin industry because it's so attractive, right? And because it's so large. The second thing is that I think people realize that stablecoins are a distribution mechanism for their currency globally, because one of the few industries that is experiencing more globalization while other industries are experiencing deglobalization is the blockchain industry, right? So the blockchain industry experiences greater and greater global connectivity and global growth, while many other industries, due to ideological reasons or political reasons, are deglobalizing and becoming kind of locally focused, right? Manufacturing and other key topics where cooperation between countries is not possible for various security and geopolitical reasons. It's very important that stablecoins continue to be backed by the US dollar for the US dollar's role in the global financial system, and definitely for the US dollar's role in the new global financial system, which runs on the Web3 Oracle network blockchain technology stack. This dynamic of enough economic force appearing to gain the attention of the US government and other governments will just continue, right? So once a sufficiently large size of funds, mutual funds, money market funds, whatever fund structure you want, once a sufficiently large percentage of those funds are in a blockchain tokenized form, then that industry and the respective regulator and the respective government agencies have to figure out a plan for the tokenized form of that asset. It's the same thing with real estate. It's the same thing with commodities. If a large enough percentage of global gold is tokenized, the agencies that manage the risk around commodities will have to come to clarity on how tokenized gold is made to operate, what you need to prove about the tokenized gold from a proof of reserves point of view, for example. How do you take a tokenized gold token and mint it and burn it across chains so that it isn't stolen, so it doesn't create some kind of large systemic financial risk, for example? So this is just the beginning, right? As the market share of blockchain technology grows in each respective asset class, the industry participants and the government regulators and the government legislators that oversee that specific asset type will become increasingly interested in how it should be done in a risk-adjusted, secure, reliable way. And this is basically where Chainlink comes in, and where Chainlink starts having a lot of use value to both the industry, the regulator, and the legislator, because it allows them to create a system that through an infrastructure guarantees certain things about the asset, right? So proof of reserves is a good example for stablecoins. How do we legislate into existence that the stablecoin that you have is actually backed by a US dollar in a bank account somewhere or in a treasury somewhere? How do you guarantee that and verify that in near real time so that it doesn't turn out that all the stable coins that someone has actually are not connected back to a dollar in a bank account or a dollar in a treasury, because that would be a very, very serious failure mode, right? And once the size of that market is big enough, that failure mode could become so large that it could affect the economy, at which point the regulator and the legislator needs to be involved in managing that risk, right? That's now at a size where they can't ignore that possibility. It's actually their job to oversee the management of that risk. So this will continue to happen. You will see larger and larger percentages of different asset types. You will see it for hard assets like gold, various commodities, real estate. You will see it for derivatives contracts. You will see it for all the currencies. You will see it basically for all assets that currently exist. And as you get to like 1, 2, 3, 4, 5, 6, 7, I would be really surprised if you got to, beyond 5% of the total value of some asset, and all the regulators and all the governments and all the legislators weren't completely running to make sure that that asset was properly managed and regulated, right? Because once you get even to 2%, you make up a large enough portion of that total market that if something was wrong, if there was some kind of fraud, if someone stole something in mass, that could tank that market, that could tank that asset class, that could have a very bad impact on an economy as a whole. And they're responsible for that economy, right? So they really can't ignore this new format at that point. They're interested in, how do I properly make sure that the cryptocurrency trend and Bitcoin and those crypto assets work out in a way that doesn't damage the economy but grows the economy? How to create market structures where I start to lay the foundations for real world asset issuance by DeFi startups, digital asset issuance by fintechs and institutions, and various other forms of regulated tokenization, which is very good and important and something the U.S. needs to catch up on. And then finally, how do I manage the risk of stablecoins making up a very large percentage of the total treasury market? And as it makes up a large percentage of the total treasury market, how do I actually make sure that it becomes a useful and effective distribution mechanism for the US dollar, not just a part of the market, right? How do I actually turn stablecoins into an advantage for my economy such that my currency, like the US dollar, is suddenly very widely used in this new category of transactions? But that's just the beginning, because you will see this massive increase in the total percentage of an industry that's on-chain, and then the regulator, legislator, and industry participants will have to deal with that new format. So it's really going to be the power of our technology, of cryptographic guarantees, of a better way of doing transactions, a better way of proving things about assets, a better way of financial markets operating that is going to float our industry into these larger and larger percentages, at which point governments will be forced and have to engage with the technology in our industry, and at which point Chainlink as a community and as a set of technologies and as a set of open standards will be, I think, in a very good position to provide that answer of how do I properly make sure that the stablecoin works correctly? How do I make sure that it's transferred across borders correctly? How do I make sure that the asset that's generated is highly reliable and we actually connect the on-chain version of the asset to the off-chain reality of what's going on with the asset? How do I manage all of these risks in my new Web3 version of the financial system? This is now what Chainlink is becoming more and more. It's becoming a set of global standards that multiple different financial systems are starting to use to manage these risks, manage the complexity of not only data and cross-chain transactions, but how you actually define compliance and how you manage and automate compliance in a way that allows the best assets to be generated in your financial system, allows them to be highly reliable, allows them to be connected to liquidity in other financial systems, and allows that liquidity to very easily and efficiently flow into your financial system, because the problem of compliance and the burden of compliance has been automated to a massive degree, which fundamentally is what we all want, right? We don't want higher transactions due to compliance, higher transaction fees due to compliance. We don't want riskier assets that don't prove anything. We want very reliable, very real-time verified assets. We want the cost of a transaction, the cost of compliance to be very low, and we want all of this value to flow freely across borders to create this global financial system that's more reliable, fair, and verifiable.